Hey everyone, thanks a lot for joining us. So today we're going to talk about the ongoing and recently started TLC insurance renewal cycle. American Transit and Hereford have now officially released rates. So I think it's a topic that a lot of people are interested, a lot of people are going to deal with. And so let's speak about it. So for those who haven't followed us or seen our content before, what we do is we draft up a newsletter article. We embed the video that we're currently doing in this article that speaks to it. And yes, we go long form, but I'm trying my best to keep this shorter and shorter and shorter. Today's article, I think, will be very interesting. It's more technical, and so let's get right into it. So the headline of the article is ATIC, American Transit and Hereford announced 2025 insurance rates. Search NYC TLC brokers on AutoMarketplace.com. So American Transit and Hereford. So the abbreviations for both of these companies are ATIC and HIC, although ATIC is more commonly used. Hereford just referred to as Hereford usually. Major insurers to the NYC Fire Transportation, TLC industry have announced 2025 rates. Use AutoMarketplace.com to find TLC brokers and more, and we'll get into that at the end. So bullet points. Fears of large one-off catch-up rate increase due to technical insolvency of American Transit have not materialized. Bullet point 2. ATIC is increasing 2025 NYC for-hire vehicle insurance rates by 2% to 8%. We'll get into more detail related to that. Hereford is raising NYC FHV rates by 3% to 10%. Rate increases can exceed the headline guidance if a driver's or fleet's record is impacted by other factors. For example, at-fault accidents, DMV points, vehicle age, and then AutoMarketplace.com launches to help drivers and fleets find NYC TLC insurance brokers. So this article is actually not very long, but I think there'll be some technical details spoken in it, which I think a lot of people will find interesting. So NYC TLC insurance renewal season has officially begun for a large majority of for-hire transportation, otherwise known as TLC drivers and fleets. Many policies expires on March 1st, not all of them, but many, and are typically renewed in late January and throughout February. Given that American Transit Insurance Company, ATIC, provides insurance to over 60% of NYC for-hire vehicle drivers and fleets, many were understandably nervous about how rate increases were going to look like in 2025. ATIC, and this story has been covered by us, by Bloomberg, by many other media organizations, now officially insolvent and under closer regulatory scrutiny, has long been accused of artificially underpricing TLC insurance to maintain its dominant market share. And so we wrote an article back last February, about almost a year ago, and here's an excerpt from it. So explaining what we mean by the underpricing of insurance and how ATIC basically used that to maintain its market share. That's the accusation. So we wrote, if the dominant player can continue to operate with razor thin margins for years, or is indeed effectively insolvent, again, this is February of last year, that is a nightmare competitive backdrop. Right now, our guess is Warren Buffett controlled Geico is probably not interested in the NYC taxi insurance market. American Transit might be too big to fail, or said another way, impossible to effectively compete with. Okay, we'll read these two paragraphs and I'll just go over what is meant by all of that. Consequently, given the recent headlines over the past several months regarding ATIC, one might have expected New York State's insurance regulator, the Department of Financial Services, DFS, to approve significant catch-up rate increases. Such an increase could attract more insurers to the marketplace and enable existing companies, including ATIC, to strengthen their financial positions while offering actuarially sustainable rates. That being said, given the size of American Transit's market share, the ongoing tax medallion crisis, and the rise of driver lockouts, an excessively large increase could overwhelm the industry. Drivers and fleets accustomed to prevailing rates, albeit actuarially, and I'm probably tongue twister, unsustainable, have built their livelihoods and businesses based on certain assumptions about the ongoing cost of insurance, a significant expense. So let me take a few minutes to explain what that means. Basically, the simple point we're making here is that, the big story since probably August, September, is that now ATIC, the largest, player in the marketplace, in the NYC TLC insurance marketplace, is insolvent. So then the DFS has gone involved. And so an accusation related to American Transit, especially from other competitors and other players who were interested in the marketplace, is that they were artificially underpricing policies to maintain market share. So they were selling, hamburgers that cost $2 to make for $1. And so no one could compete with them. Just I'm being super simplistic. And so now that can't be allowed to happen in insurance. So now that that's being called out, a lot of people were afraid that, oh man, like now this is being called out. So is there going to be a massive like catch up insurance rate increase given the insurance was underpriced, or at least that's the accusation. And so that was the fear around this. And then so if indeed they allowed in this year a massive like 50-60% plus increase, to basically, let's say 5 or 10 years worth of increases in 1 year to catch up, if you will, that's going to have a significant impact on people, because right now there's a lot going on in the marketplace. That's outside of there's obviously important passenger considerations related to protections, but there's a yellow cab crisis that's kind of recovery still going on. There's these driver lockouts, which is like a big topic, and unsustainable, like earnings are not as uh, uh, drivers are nervous about how consistent their earnings are. And so, given this whole backdrop, if you increase it right now, like that could cause, chaos. And unfortunately, we have to use the word chaos because, I know that term is sometimes overused, but it could cause chaos. Okay, so driver pay and insurance inflation. So if a TLC driver or fleet and one of uh, if you're a TLC driver or fleet and one of your largest expenses increases by 50% in a single year, many simply won't be able to absorb that cost without taking a significant pay cut or losing profits, assuming there are any to begin with. And we've talked about, fleet economics and how much drivers get paid. So let's say a NYC TLC driver has to pay $2,000 more per year, about 165 for them. Obviously, for those who might, the way it works is that you make a deposit and then you don't like a deposit up front. So it's kind of over 9 months, but I'm just being simple. I'm just doing 2,000 divided by 12, just in case someone's like, you know, they're held up on that technicality. But let's say it increases 2,000 more per year, which is on a run rate basis 165 more per month for their commercial auto insurance. Is their income increasing by that amount? That's simple enough to understand. Addressing how to create an industry where all NYC TLC drivers earn a fair wage, one that accounts for real industry specific inflation. There's a topic we've spoken about a lot, is a complex and ongoing challenge with many differing opinions. For example, some might argue that Uber and Lyft could reduce their commissions in New York City, their take rate, especially since it's the only market in North America where UberX drivers directly pay for their commercial auto liability coverage. I'll speak about that very briefly after I read this. Others, such as driver advocates at the New York Taxi Workers Alliance NYTWA, might suggest that a public subsidy is necessary, particularly in light of the multi-decade regulatory failure surrounding American transit. So if the regulator failed, and this is why there's a crisis, then maybe the government, a subsidy is needed. It would be an argument that has been made by NYTWA. The TLC might be contend that the built-in inflation protections in the driver pay formula would at least partially offset the increased cost of doing business. Another perspective is that if the regulator managed the FHV license TLC plate supply more effectively, they could structurally protect and even increase driver wages, via basic supply and demand. If you only allow a certain number of, FHVs / drivers in the market, and there's only X amount of trips growing at, Y, basically it's like supply and demand. If you allow more and more for hire vehicles and drivers on the road, that can also dilute earnings structurally. So with the public hearing, and to be clear for those who don't know the background, the TLC is tasked with managing for hire vehicle supply. So this is something unique to New York City, but the TLC actually manages for hire, like how many for hire vehicles there can be. And that's same with the taxi medallion industry, the yellow cab industry. So with the public hearing related to TLC's driver pay formula scheduled for 10 a.m. next Wednesday, February 5th. We'll publish another article and video focused on driver pay and potential solutions to rising insurance costs. So basically, there's a huge meeting happening next week related to lockouts and utilization rate and all of these things. It's not the focus of this article. We just want to talk about, what are the insurance rate increases, what's happening in regards to that. But it is important context. And just to mention on this point where Uber and Lyft could reduce their commissions in NYC, especially since it's the only market in North America where UberX drivers directly pay for their primary commercial auto liability coverage. This is a point we've mentioned in the past. So in New York City, like in other markets, if you're an Uber Black driver, you usually need commercial liability insurance. So you're paying for that insurance, like $1 million plus insurance. Like in New Jersey or Florida, you're like a Uber Lux or Uber Black driver, whatever the terminology is used in those markets. In New York City, it's the only North American market where, like, just to be like an Uber X driver, you are actually paying commercial insurance directly. So this market is particularly profitable for Uber because they are not on the hook for the primary insurance. They'll argue that we have to pay for umbrella insurance, but the primary policy that's hit if an incident occurs is the policy that a driver or fleet pays for. That's very unique to New York, that dynamic. And so if Uber's taking 25% and not really paying for the primary commercial liability insurance, there is a very legitimate argument that, they could their take rate could be reduced, to help out drivers and fleets related to, large insurance rate increases. Okay. DFS will likely not approve large rate increases. In the meantime, in a letter viewed by AutoMarketplace and first reported on by Bloomberg, New York Governor Kathy Hochul, and we have all the hyperlinks, you can click these. New York Governor Kathy Hochul has recently introduced legislation to help stabilize the NYC TLC insurance market. In this letter, the governor's office mentions that this year's state budget will include proposals to phase in rate increases over time, balancing drivers' needs while allowing fares to adjust to their associated costs. And so here's a quote from the budget that relates to that. And so the importance of this is that under current law, the DFS is required to approve only actuarial sound rates, which, to our understanding, is why new legislation is being proposed. NYC TLC drivers and fleets should not expect any large one-time insurance rate increases in the near future. So what we're saying is based on assuming that the law is passed as is, or the proposed legislation bills are passed as is in the New York State, for New York State, then they're preventing a large one-off increase because they also understand, the government's not dumb. They also understand, the DFS understands that if you do a 60% one-time increase to a market that's already has different headwinds, that's going to cause all sorts of chaos. So we just want to address that. That's the background to why there was likely not a massive one-off large increase that many people were fearing, drivers and fleets were fearing. So with the above context in mind, the article will now focus on officially announced NYC TLC insurance rate increases for this year from American Transit and Hereford. And these are the two dominant, this is like a duopoly, insurance players for NYC Taxi and FHV commercial liability. Additionally, we will discuss how drivers and fleets can use the newly launched AutoMarketplace.com. It's a site we launched. We'll get to that at the very end to find a TLC insurance broker for questions and quotes during this busy renewal season. Okay, let's talk numbers. American Transit is raising rates 2% to 8%. So according to communication we've seen, these are the official rate increases for the 2025 renewal season and new policy. So Yellow Cab, it's only a 1.95% increase. What they call black car and car service, which we, in our understanding, is mostly Uber, Lyft, and like basically other black car base rates, they're going to increase 6.3%, and then for fleets and cap policies, it's a little. The increase is going to be a little bit more, 7.7%. Hereford is much more detailed in explaining its rate. So ATIC was 2 to 8%. Hereford is 3 to 10%. And so according to an official communique from Hereford, same thing as the above. Now, Hereford has 16 categories, and I don't think you need to get lost in this, but basically for yellow cabs, and we understand American Transit is a more dominant market share in the yellow cab market, but yellow cabs are 4.5%. For Uber, Lyft, and traditional like black car based drivers, it's basically 4.5% for fleets. That's the high end. Uber, like black cars, corporate scheduled driver, I think that's fleet policies. It's 10%. So pretty big increase there. I mean, big increase in however you want to, whichever side you're going for. But from a fleet side, that's a big increase. And then there's all these different categories. But basically, 3 to 10% for Hereford, ATIC 2 to 8%. Those are the official rate increases. However, this is what makes it this is basically the below. It's not as simple as, oh, the announced rate. It's an important announcement, like these are the officially announced rate increases, but then you also have to, it's a little more complex than that, so we explain it. While the headline figures above provide insight into the officially announced DFS approved rate increases, some drivers and fleets may experience larger increases or even see their premiums decrease. This can be explained by a variety of factors, including, so we're not going to list every factor, but it's important to understand how, like, let's say your friend has a $4,100 rate and you have a $4,800 rate, and you're wondering, like, why is mine $700 different, or your fleet, etc. So these are some like very common factors that can affect the rate beyond the headline increase, and affect the rate in a positive and negative way. So driver experience. Typically, if you've had a TLC or DMV license for less than a year, 1 or 3 years, insurers will add an inexperience surcharge. This can increase your insurance premium by 15% or more. So that has a significant increase. I'm not sure if it's the entire premium will be 15% or more, but maybe parts of the coverage will be 15% or more, but it can basically increase your premium. At-fault accidents. This might be a little obvious. If you've been involved in at-fault accidents, this can impact your rate. So in Hereford's underwriting guidelines, which we've seen, they state, there's a quote, any policy written where the insured or listed driver has had more than one chargeable accident within the last basically a little more than 2 years will incur a minimum 10% surcharge and may be considered at the all other rate. The all other rate might be 50% higher than the standard rate. So there's this thing called all other, which is like, let's say the standard rate is 4,100. The all other rate might be like, honestly, it might be like $8,000. I don't know how many people that happens to, but it does happen to people. Hereford also clarifies that, and they actually define like what is an at-fault accident. So it clarifies that, quote, a not at-fault accident is defined as a property damage accident only that results in damages of less than $2,000. Additionally, if the insured was found to be 33.33% or less at fault in the accident, that loss will be classified as a not at-fault accident. So, a lot of details there, but this is giving you background to like how rates can be impacted beyond the headline figures, and how this is working in the background. I think some people, this provides very specific insight into the mechanics of it. And obviously there's a 27-month, a little more than 2-year window on this. So if you had an at-fault accident like 5 years ago, it doesn't seem like it's going to impact your rate anymore. Okay, a couple more. Claims history, including pedestrian and bicyclist accidents, your loss run history, or what an insurance company has historically paid out and reserved for claims related to a driver or fleet can also negatively impact rates. For example, Hereford states, in the event an applicant is considered that has had an accident within the last 24 months, 2 years, involving a pedestrian or bicyclist, that policy will incur an additional 10% surcharge. What's interesting about this language is it doesn't actually clarify that whether if the bicyclist accident is at fault or not at fault, if it just like, or is just occurs, but maybe it does imply that, but just FYI, just intriguing. Points and speeding tickets. DMV points are on a driver's motor vehicle record, can also impact rates. Hereford states, if a driver on a policy has 5 to 10 points on their MVR within the last 39 months, so a little more than like 3.5 years, 3 years and 3 months, a 10% point surcharge will be applied to the policy. And if a driver on the policy has more than 10 points on their MVR within the last 39 months, a 20% point surcharge will be applied to a policy. And just to give you an insight in terms of DMV points, like a speeding ticket can like get you like, I think it can get you like 3 to 6 points if I'm not mistaken. Even like a very common one is like if you're on your phone, that can get you some points. Moving violation. So different ways to get points if it's and that's on your motor vehicle record. And I think like from the date of conviction, it lasts I think 2 or 3 years. So let's say you got like a cell phone, like a cell phone point or a speeding ticket like 4 years ago, but you didn't actually settle it till last year. You still have to wait. It won't lapse. It will lapse based on the conviction date in which you settled, not on when it occurred. So some drivers sometimes are surprised by that. Vehicle age. If a driver or fleet's vehicle is older than a certain number of years, it can also cost. It can also uh, increase the cost of your policy. Hereford states policies that insure a vehicle that is older than 11 model years, including the current model year, will incur a 15% surcharge. So American Transit also imposes a surcharge on vehicles that are more than 5 model years old or from 2019 or earlier in 2025. So basically, if you have a 2017 model year car, that can also increase your rate. So other factors can also influence and even decrease a driver's TLC insurance rate beyond the announced headline rate increase. For example, drivers with the defensive driving certificate, which is a requirement when you do get and renew your TLC license, may qualify for 10% credit. The list above is intended to represent common factors, but does not include all potential factors that could impact your final TLC insurance rate. So our point here is okay. The headline increases are like 2 to 8% for ATIC. Hereford is 3 to 10%. But like, let's say you get your insurance rate and it goes up by 15 or 20%. You'd be like, wait, AutoMarketplace said that it's 2 to 10% maximum. Well, that depends. And we would ask if you need help in this. Email us at info@automarketplace.com. But the automarketplace.com. But the easiest way to understand why your rate increases is ask your broker, like, why did my rate increase? And so it might be, for example, you have points on your license, or maybe last year, if you have a 2019 model year, let's say last year that didn't have a older vehicle surcharge, but this year it does for American Transit, for example. So beyond the headline rate increases, your insurance rate can go up for other reasons. So in our 2024 NYC TLC and industry overview, again, hyperlinks everything, we reported liability rates had generally increased between 10% to 30% for drivers and fleets, and gave the following ranges. For individual liability rates, like owner-driver rates, are mostly between 4,000 to 5,500 per year annually. For fleet rates, they were like 6,000 to 9,000, and for cap policy rates, like 8,000 to 10,000, 11,000. So now, if we kind of layer on the above rate increases with our increased knowledge of speaking of brokers and what's like actually happening in the market, so the individual liability rate range, we've heard like I think 3,900 is the absolute minimum, but basically the range mostly is between like 4,000 to 5,100. So you might be saying, well, like that's flat on last year. And we'll get into this later, but we're basically refining our methodology from last year. So maybe this was slightly overestimated last year. It's not totally off, but we're now refining our methodology because to figure out these ranges, like there's all these factors you have to put in to the headline increases. So we refined our estimate of individual liability rates. However, for fleet liability rates, that is up 20% plus. So in 2024 is 6,000 to 9,000 per year. This year, it's seeming like 6,800 to 9,500. So those are up. Cap policies also up. 8,000 to 11,000 last year. It's seeming like 9,500 to 11,000 this year. So over the past 2 years, AutoMarketplace estimates that most NYC TLC drivers experience a cumulative inflation. Yes, a big range, but there's a lot of factors of 5% to 20% in their commercial auto liability insurance premiums. Many fleets with corporate policies likely face an additional 15 to 20% insurance-related cost inflation. So a lot of fleets experience, 20% to 40%, if that makes sense. As mentioned above, what makes this exercise tricky is that TLC insurance rates are influenced by many other factors. Our ranges are based on conversations with TLC insurance brokers, providing us with insights into current market trends. This explains why our range for individual liability rates has narrowed and appears unchanged versus 2024. We're essentially refining our methodology. Our rate guidance reflects an informal weighted average of insurance premiums that most drivers and fleets should expect to pay in 2025. And then our last section is using a real life example from our own fleet that we manage. So just to confirm to people, so if you're an individual NYC TLC driver with a relatively clean record, and obviously if you have other things going on, then there's surcharges, but you should expect a policy between 4,000 to 5,000. If it's higher than that, then something's going on. But that's most individuals will be in that range. We're pretty confident in saying that. For fleets, if you don't have a cap policy, it's probably going to be like 7,000 to 9,000 in that range. And for cap policies, it's getting expensive. It's approaching 10,000 plus. So those are our 2025 insurance ranges. And obviously you have to, layer on the factors and how that will impact it. So these are, last section in this article. In our quest to be more specific and technical, this year we've decided to launch an informal NYC TLC insurance index. Since 2017, and many people know we got our start in this industry by running a fleet, and we still run it. Our fleet has paid over $840,000 in commercial auto liability premiums, and we'll begin by sharing our own data and experiences. In the future, we plan to include additional data points from individuals and fleets to provide better insights through the index. Notably, our fleet and drivers, and drivers obviously that are involved in our fleet, has maintained a cumulative 40% loss ratio over the past 8 years. We'll get into that later, which would be considered highly performant. Other fleets with worse loss run records have likely experienced greater insurance inflation. So we've performed pretty well with our fleet in terms of how many loss ratio just means how many premiums you've paid and how much the insurance company has paid out. So obviously if it's above 100%, that means if you paid 800,000 of premiums but the insurance company paid out 900,000, then that's not a good situation. Additionally, our fleet stopped growing after August 2018 when the FHP licensed TLC plate cap went into effect. So as a lot of people know, there's a TLC plate cap and there's an FHP license every year, but that happened in 2018. So that was the end of our fleet growing. We also permanently retired several TLC. We're mentioning this because it's actually relevant to our analysis. You might be wondering that. So we also permanently retired several TLC plates due to a technicality. Some FHP licenses were held in the names of individual shareholders rather than under a corporate entity. This personal liability risk to our shareholders was deemed too significant, leading us to return TLC plates in 2020 and 2021. A lot of people might be intrigued by what we mean by that. Basically, you can hold before there was a FHP license pause. You could still do today with a wheelchair accessible vehicle, but you basically could claim FHP licenses in a corporate entity or in an individual name. And obviously the individual names, as seen above, have actually much more cheaper rates. And the logic behind that is if it's an owner driver, again, the logic is that the risk is less. And there's probably the data probably shows that, although we would argue based on our loss ratio that a good fleet manager can, that's a different topic. But in any case, when that happened, no one there were certain TLC plates we had and we were new to the industry that were actually in our shareholders individual names. So we had determined that those, I think there were 3 or 4 of them, those TLC plates, we would rather just retire them because there's too much personal liability, because someone can go after an individual, if that makes sense. And you can't change that once it's a FHV license, a TLC plate is attached to an individual name. There's no way to change that. So we retired some plates. It's relevant because we're going to show you our data and then why we're using the years 2022 and 2024. With that context, the absolute like for like insurance inflation experienced by our fleet can best be measured between 2022 and 2024. To be fair, although our fleet's driver retention is strong, there's still natural attrition that requires us to onboard new TLC drivers with varying driver records and levels of experience. This in turn can cause policy rates to fluctuate and sometimes overstate or understate the true underlying insurance inflation. So, what do we mean by that? For example, if a longtime TLC driver with a perfect driving record left the industry and our fleet in 2022, and we replaced them on the policy with a driver who had only held both a TLC and DMV driver's license for 2 years, it would increase the underlying policy premium. However, that increase would not be driven by inflation, but rather by actuarial factors, such as an inexperienced driver surcharge that didn't apply previously. Our point is that, okay, you obviously see this is from our fleet, like this is real data that we're sharing, we're being completely transparent. What we're basically saying is that, so we're not going to, obviously this is when we kind of started out in the fleet and then the fleet stopped growing and we handed in some TLC plates. So from these years are kind of very hard to compare like for like, to say like this is the inflation we experienced. Our other point in this is that if a TLC driver, let's say, leaves our fleet for whatever reason, although we have high driver retention, we have high customer satisfaction, if the actual driver, like let's say they're inexperienced versus the previous driver, that's not actually like, it's kind of unfair to say that's insurance inflation because it's just like an actuarial factor that didn't apply before now applies. So if we had a similar like for like driver before, then that previous rate would have been higher. That's all we mean by that. If you're confused by our point there, just like let us know in the comments. But I think you understand what we're saying. So that being said, given our loss run history and relatively high driver retention rate, we believe the absolute increase in our fleet's insurance premiums between 2022 and 2024 is a reliable measure of experienced insurance inflation for many TLC, NYC TLC fleets, and even for some individual drivers. So these are the actual premiums coming from our fleet. Our fleet is a little more than 20 vehicles. Obviously, we couldn't grow since 2018, and we haven't bought TLC plates or anything like that. But from 2022 to 2024, there's like about the same number of TLC plates. We had high driver retention. So these 3 years are kind of like comparable. And like these are a loss run. So it's kind of like, we started in the industry. You probably were bad at driver screening, or I have to remember what that incident was. Or maybe there was like, yeah, like kind of a frivolous lawsuit or something. But in any case, 2018 was a bad year for us. But then since then, and then 2020 was also, not a great year. Just, basically all the premiums we paid, the insurance company had to pay all the premiums we paid that year. The insurance company basically more than paid out. However, since then, we've performed pretty strongly as we've gotten more experience and better at, managing our fleet. And so this loss ratio, 40.4%, is simply like, okay, how many and this is to 2024. Obviously, we don't have the 2025 rates yet, although the renewal rates have been published. They're still coming up with the rates to give us, but we should have them very shortly. So we've paid $850,000 in TLC liability and premiums. This excludes any comp and collision insurance we've paid. And the insurance company, excluding reserves, and we'll get into that, the insurance company has paid out $343,000. So you could say on a cash flow basis, they've made we've been a good business for them. Now they have overheads and stuff like that. So it's not like they made a 60% profit margin. That would be unfair for us to say. But let's say the overheads account for 40%. So maybe they've on a, it's hard to really determine this because there's so many policies, but they've made 10 to 20% profit on our company. Let's say we've been a profitable enterprise for the insurance company. So if we look at our 2022, 2023, and 2024 rates from this, there was 14.4% inflation from 23 to 22. And then there was almost 25% inflation from 24 to 23, although it's hard to do better than 0 in 2021 and 4% in 2023. Now, to be fair, this is an important footnote. losses represent case reserves and do not account for any, I don't want to make up with that. I have to, it basically claim development. What that basically means, I think, is that like this is what they've reserved. So maybe they're surprised and they got to pay out more than they reserved. So there's that lingering, but I assume they're pretty good at this and there's regulations related to that, but maybe I could be wrong on that. But that's how our loss ratios look right now. So our fleet, like this is like a real, this is a real data point about the TLC insurance inflation that our fleet, the fleet, we manage experienced over the last 3 years. Our fleet's compounded TLC, NYC TLC insurance inflation has averaged approximately 20% annually from 2022 to 2024. So it's like 14% this year, 25% this year. So basically, it's only over 2-year comparison period. So it's roughly 20%. Additionally, think about it this way. Additionally, our fleet has maintained a strong loss run record, particularly compared to peer fleets, which is another important factor to consider. So think about this, if we have a 40% loss ratio here, like we're doing pretty well. I don't want to jinx it, but we're doing pretty well thus far, especially in recent times. If we did well and our underlying insurance is inflating at 20% per year, just imagine a fleet that maybe has 80 or 100% loss ratio, which is not unheard of, or 60% loss ratio. They could be compounding at 30%. So then can you pass along that cost? It gets very tricky. Like it eats up your margin as a fleet. Now at the same time, drivers are also exposed to maybe not as intense inflation as fleets, but they're also exposed to insurance inflation. And that's, as you mentioned above, that's also going to eat into their earnings if like last year, I think the driver pay formula went up by 3, and we wrote an article about this, but like it went up by like 3.5%. And our point was like, you're like, is what TLC drivers, NYC drivers, and fleets supposed to believe that 3.5% inflation represents the actual inflation that drivers and fleets experience when insurance is a major cost? That doesn't make any sense. And because they're using regional inflation metrics, so we have argued that those are not accurate metrics to use. They should come up with a much more industry specific metric. Now that's a topic for another article, but we gave you a real life example about what's going on with our fleet. Okay, so now we'll very briefly talk about our website because we're just launching it. But given the ongoing NYC taxi and FHV insurance crisis, we believe we are well positioned to help drivers and fleets navigate TLC insurance. I mean, we've had experience like beyond just paying for insurance. Yes, like, okay, we paid for insurance, so therefore no, it's not as simple as that. We have reduced claim payouts. We have helped drivers. Like just the other day, one of our drivers got rear-ended. They've never done an insurance claim. We kind of gathered we did claims management for them. We gathered like, okay, how much information do we have? Then we reached out. Then we filled out an MV 104, all of this claims administration. And today, the claims adjuster came, the other driver is at fault, also protects our fleet policy because we're not at fault. We could prove that they rear-ended us. But there's a lot of like paperwork and administration related to that. So, we've experienced a lot of different claims. And so we have real experience not only paying insurance, but like in claims management. I'm going in and out. We also have a business that we help fleets. They're actually bigger than us usually, to manage their insurance. So right now, for example, we have a customer with about 50, so it's more than double the size of our fleet, and they've had issues with like undisclosed driver claims and like things like that. Undisclosed driver claims are very common fleet issue where basically like you're changing drivers but you forget to tell the broker that, oh, a new driver is driving that. Then if you don't tell them that, then the new driver gets into an accident and the insurance company's like, wait, we thought John Smith was driving and Al Smith got into an accident or Al Jones got into an accident. And that's a humongous headache. And not a good situation, very annoying to the insurance company, very annoying to the claims process. Um, and so we've helped them, we've worked with their team and helped them. And this year, their undisclosed driver claims have gone to zero. And their insurance claims, just like incidences, have really declined. Not only due to me, but also their team has been amazing. But I've helped out in that. So this is something that, like, insurance is something that, like, I don't. Our team and me personally, we don't just, like, it's not like a concept. We're paying insurance, we're doing claims management, we're advising fleets, we know TLC insurance brokers. So this is something that, like, we know very well. So in any case, that's kind of the background to where we're starting AutoMarketplace.com. So it aims to provide greater transparency in the otherwise opaque NYC TLC insurance marketplace. Over the past several months, the Auto Marketplace team has contacted more than 25 TLC insurance brokers, identified those with whom we and our clients have had positive experiences, and then mapped them out. While there are still more brokers to contact, ratings to refine, and we're not giving, if we didn't have a good experience, it's not like we're gonna list them and give them like a 2 point. We just, like, they're not included in the directory, so we're not being negative. While there are still more brokers to contact, ratings to refine, and significant work to be done on the site, we're now ready to share our website and invite people to sign up. So this is like a beta, version of a website. It's launched. It's like far enough along. We've worked. It can be used, but just know if, like, something messes up and stuff like that, let us know, give us feedback. But we're ready to launch this, and sometimes you just need to launch something and get feedback and build from there. So at a basic level, automarketplace.com makes finding and contacting insurance brokers who offer TLC insurance much easier. While this might sound simple, so you might be saying, like, doesn't that exist? Those in the industry, so we've been in this industry for long enough now, know that this task has historically been quite challenging. Be sure to check out our video overview, this one we're doing right now, on YouTube, and our Substack podcast as well. So there is not, like, this might sound crazy, but a lot of TLC brokers, they can even be good. Like, they don't have a website. It's, like, hard to understand who's located where, and it's very, like, hard to navigate the marketplace. So this is our website, automarketplace.com. Now there's web that we're not going to talk about. What it's interesting, and please navigate it. We're going to do many, many more articles. I got to update that to 2025. But basically, like, these are our ratings. Like 3.5 is good, very good, excellent, and just we'll go here. It's like, Google, Yelp, other online ratings are helpful, but many shops and vendors manipulate their ratings. Are there really that many 4.0 places to do business? Remember, many reviews are user generated, and while useful, such a rating system can be abused. To help create a better system, Auto Marketplace created its own rating methodology based on private verified user feedback and our own experiences. So that's how we're generating the ratings. But very practically speaking, let's say you're not happy with your broker. Let's say you just want to explore, like, the different brokers. And obviously we have different categories that we're adding to here. But let's say, you can either, search here and then, like, use your location here. But let's say you want TLC insurance. So we've listed 29, some we've done the pictures for, some we have to map out. But, very simply, like, you can just see it. Like, let's say, who's this here? Next Entry Insurance. We got to get pictures from them. But 4.6, NYAB Insurance. They're a really good guy. We've done a podcast with them, very good people. Omega, they're a very good broker. They're also a partner of ours. And the other thing we've built in is that, and then, so that's simple enough to understand. Like, you can basically, let's say you click on Omega, like, this is pretty simple. Like, there's some pictures, sometimes, like, just seeing, understanding, that's the location, that's our rating. You can click that call button, you get a call. You can book an appointment via us or send a message via us. These are their hours. And this is the cool thing that we built in. Like, sometimes, like, if you're using a cell phone, and we'll go to the mobile view of this, you can actually, we've built in a way where if you enable the current location, you can just click Google Maps and Waze, and it directs you to there. So now this is actually the mobile view of how the website looks, and obviously more people than not are going to be using the mobile view. So let's say you're looking for TLC insurance, and let's say you can either see the map, zoom in, and again, we're refining this. simple enough. It's just basically a directory right now. And so let's say you click Omega, you can see the pictures, nice place, and these are our own pictures that, the team. And I should mention that, Jason, Sean, Adrian, Cruz, which we've seen in other videos, you know, they are as critical as me in building this website. And some of this functionality should kind of work, but if it doesn't, like, forgive us. You can message or book via us, or you can just simply call them. We're just trying to make this easy, basically. And then you can click Google Maps and Waze if you enable the location. And that's the website. It's just like trying to make, you know, life easier. Now, there are other services. We haven't really built it out yet, but we're launching with TLC insurance brokers. And so, we hope you find that helpful. Now, I'll actually just briefly mention something. This Web3 thing, if you have time, read it. We're going to do a whole separate video, on that. But it's kind of an interesting concept and something that we're very focused on. The team and I are very focused on at AutoMarketplace. Okay, so that's the video for today. Let us know any comments. We hope it's helpful. We hope you have a good insurance renewal season. We hope your insurance rates don't go crazy high. But we hope this provides useful information for you. And until, we'll see you soon.